Welcome back to Finance Friends. I'm your host, Fabian, and this is season 4. This season, we're diving deep into the world of investing. Not just where to put your money, but how to think like a professional investor. We are bringing you conversations with highly intelligent, incredibly motivated investors. With weekly episodes, make sure you stay tuned in. On today's episode of Finance Friends podcast, we had Mike Harut, who is the responsible investment manager at Munro Partners. They're an $8 billion Australian investment manager and they invest in global equities. Talks a lot about their Climate Change Leaders Fund and their transition to clean energy and which companies they're invested into. He also is a lecturer at Melbourne University in sustainable investment. The last year in the Climate Change Leaders Fund has done over 35%. Have a listen in to understand his investment process and some shares he's invested into. Good morning, Mike. Welcome to the Finance Friends podcast. How are you this morning?
Yeah, very well, thanks. Good to be here.
Good to have you in the studio. We were talking a little bit. You've just returned from a trip from London, was that right?
New York, actually. New York and Canada. So, I was seeing some of the companies in our portfolio in New York and some of the companies that we are looking maybe to invest in. And then we have a lot of our investors are actually Canadian-based, so seeing some of them as well.
Yeah, okay. So when you talk about Canadian investors, are they big pension funds? Are they wealth firms? Are they a combination of everyone?
It's more so the kind of the financial advisors, some family offices, that sort of thing. We are obviously looking to currently build out our institutional investor base in Australia and in Canada. So seeing some of those as well, and attending a conference of foundations, endowments, and so forth. So yeah, a bit of a mix.
Yeah, awesome. So let's maybe bring it back to the beginning. So study, was it always a passion for finance as a kid, or did that sort of evolve as you started studying and started working professionally?
Yeah, it's a good question. I mean, I studied commerce and law at uni. My mum is a maths teacher and my dad studied physics and actually has a PhD in physics. So I was very much, and we were new migrants to Australia when I was a kid. So I think maths was something that obviously is the same in every country. And I think that was just something that I just naturally gravitated to. So I did have very much, sort of a maths background. And then applying that to finance was always something that I found interesting. So yeah, I mean, I kind of went into uni pretty open-minded in terms of what I wanted to do. And then I just found that, finance was something that both intellectually interested in me, and I was also, probably better at the math stuff than the law stuff, to be honest. Because well.
And you obviously have had a successful career to date in the finance field. So what was your first job out of university?
My first job out of university was actually working for KPMG, but that was just for a short time. So my real sort of first job, I would probably say, was working for a group called ACSI, the Australian Council of Superannuation Investors, which probably many people haven't really heard of. But it's a group that helps the Australian superannuation funds effectively steward their investments in Australian listed companies. So, like, what does that mean? We talk about, they are large shareholders in Australian listed companies. So 10% up to 25% in your sort of average ASX company. So collectively, they're a large shareholder. And really what ACSI's role it was to effectively engage with them as a shareholder representative on how to, how these companies are actually thinking about alignment and corporate governance and those sorts of issues. So how do you align the interests of the super funds with the interests of the management and the board kind of running, the ASX 200, ASX 300. So that was my first role. And it was a lot of conversations with directors of listed companies, which was a real challenge because they don't hold back in their views, and they're obviously very seasoned people. So you really had to think quickly and learn quickly.
Yeah. So from my understanding of that role, like you might hold a, investor briefing with, the largest, the CI, chief investment officers of the largest super funds. and then you'll have the management team of the ASX, Australian Stock Exchange listed company, and you give an opportunity and ask them questions on their behalf, representing sort of the ESG elements of the company and how it runs. Is that right?
Yeah, that's right. That's right. And really, directors are elected by shareholders, right? So really the directors in that sense have a strong vested interest, honestly, to, be responsive to the shareholders. And so, yeah, that's exactly the kind of conversations that we were having. Sometimes the individuals from the various funds would join us as well, but often it was just sort of us as the sort of representative talking to them.
Yeah.
Talking to the kind of the boards of the companies primarily, a little bit the management too.
Yeah, and that would give you a good sense of what it's like to deal with management of large listed companies.
Yeah, it does because and you really sort of see actually that I think that there's it really kind of gave me a sense of that distinction between like what the role is of the CEO, the chief executive, and what the role is of the board. Really, I think the the CEO is obviously there day to day, kind of managing that sort of long term, managing the company and executing on the strategy and so forth. But really, I think often what's missed, and what I'm trying to kind of build into my current role is just that, the importance of the role of the board. Like if you have a good board that's actually overseeing the management properly, that does give you, I think, a lot more comfort as a shareholder. And really, it's just all about that alignment, right? So a good board helps with that alignment between the executives and the shareholders.
Yeah, and sometimes we've seen by a recent situation, I won't mention company name, but where the board has been held accountable for the poor performance of the company, as well as the CEO. It seemed like they weren't necessarily acting in the best interest of the shareholders.
Yeah, I mean, today my role is very much in global equities, so it's interesting. I've really, to be honest, I don't have my finger on the pulse as much on how Australian companies are going, but yeah, there have been obviously some very large, sort of high-profile examples of where that sort of alignment has really not been there and has, ultimately led to destruction of shareholder value, which is, really in that sort of from that corporate governance lens. That's what you're trying to use these levers and mechanisms to help you trying to avoid those situations.
Yeah. And then from that role, where did you end up after that?
I went kind of, I had a few different roles, but so I went from AXI to the Future Fund, which is obviously Australia's sovereign wealth fund. So I worked there for just under 2 years. Again, in a sort of similar role, helping the Future Fund. At the time, it was only 2 people. Now it's a much bigger team. Again, to sort of integrate ESG, to use their leverage as a shareholder as well to try to influence companies and try to improve that alignment. I also, I then kind of went back to AXI, where I was first, and then now, for 4 years, I've been at the global growth manager, Munro Partners. Maybe one other thing which I'll mention, which could be interesting, is that probably about 5 or 6 years ago, I started a friend of mine in the industry, and I started a course at Melbourne University for master's students around sustainable investing, ESG, and a lot of these sort of topics. So, that's been something that I've been fortunate enough to kind of be able to continue while I've been in this in my role at Munro too.
Yeah, awesome. So, can we touch on that? At Melbourne University, what made you come to the decision that actually there's a need for students to understand more about sustainable investing?
So really, so I did my degree, as I said. I did a commerce degree, I did honours, I did CFA, and really through pretty much all of that, there was a pretty distinct lack of information around ESG, and really where there was conversations around ESG or sustainability, it was very much in this very narrow exclusion-based approach where you just say, oh, well, there are some investors that don't like tobacco and there are some investors that don't like fossil fuels, and you can exclude those from a portfolio. But, hopefully to what we've been talking about, there's actually like a lot more to it than that. And so that was sort of the motivation. And so, my friend Claire and I thought, why don't we try to kind of create something here, and really, the university, it took a few years, but they were pretty receptive to it. And it's really cool to actually sort of see students kind of grappling with these topics and just getting a little bit more nuance around these things than often I think is portrayed in the media or in the sort of kind of more basic sort of discussions that sometimes happen with respect to topics like climate change. Just get a little bit more nuanced and beyond the it's good or it's bad kind of discussion.
Yeah. And so you were lecturing, you still are lecturing? I
still am, yeah. And last year it was basically 6 weeks a year, 3 hours a week. And then we do a little bit of marketing and things. But it's sort of like a side thing. My main role is at Munro Partners.
Yeah. So your role at Munro Partners is very similar, understanding companies, is that right?
Yeah.
And talk a lot about sort of ESG. So go detail what's ESG is very different to different people. But can you maybe just give us an overview of what you see as ESG?
Yeah. So my role at Munro Partners really has sort of two facets. One is to help us integrate ESG types of issues into our investments. So let me just give you a quick overview of what that means. So ESG stands for, maybe we should sort of point it out, environmental, social, and governance, so corporate governance, risks and issues that could be relevant to the performance of a company. That's sort of how we think about it. Like, we don't think about it through an overtly ethical or impact lens. We just think that there are some things that have this sort of flavor that are relevant to a company and how it will perform over the long term. So let me just give you an example. I said I was in New York a couple of weeks ago. One of the companies that was there is a company in our climate change sort of thematic portfolio, a company called Quanta Services. Quanta Services, what it is it's like tens of thousands of electricians and people in hard hats installing electrical grid, network equipment, renewable projects, etc. For that company, the most important issue is safety from an ESG perspective. So that's an S issue, so a social issue, how they treat their workers and how they keep those workers safe. So that's obviously important for the workers and keeping them safe. But for us as a shareholder, why does that matter? It matters because safety actually drives their operational performance. If they can't perform safely, they have to stop their operations. It's harder for them to recruit good people. And actually for their customers as well, like their customers demand them to work to a particular standard of safety. So for us as a shareholder, we look at ESG as that issue, as a topic for that reason, because we think that this is one of the things that will actually drive us towards a better company, finding a better investment. And so that's really the kind of core part of my role. And then maybe we'll kind of get into this a little bit as well separately. So one of the things that Munro Partners has is this climate change solutions or climate change leaders strategy or fund. We think climate change is an enormous investment opportunity that has many decades to run as we transition from one energy system into another one. And so we think that that there are going to be many investment opportunities in this sort of area. So one role for me is to integrate ESG across all of our investments and all of our portfolios. And then the other part, because climate change is probably the E or environmental issue, to sort of help our team find companies that are kind of benefiting from that transition to a lower carbon economy.
Yeah, okay. So talking about that company you just spoke about, do they publish this information, or is it up to you to dig deeper and ask the management the questions that maybe the average sort of non-institutional investor, as we might say, might not be able to locate this information?
Yeah, that's a really good question. In this case, they do publish that information, but in a way that actually we found to be a little bit hard to understand at first. So they have this measure called stuff that kills you. And when we talk to them internally, the S has a different word, which I'll let people figure out for themselves. But stuff that kills you is like this kind of conglomerated, I guess, measure of injury rates, like are there fatalities and that sort of thing. So they do publish that information. But in that case, it's actually quite difficult to kind of compare it to peers. So this was a company that we actually put onto our sort of engagement list to say, let's have a conversation with this company, understand like, have there been any fatalities in their operations? How do they think about safety? And just sort of unpack a little bit like what that stuff that kills you measure actually means. So we've had some success in, we think we've got a better understanding of what that is. And we can see like the important thing here is to just like look at the trends over time. Over time, despite what's actually like a much busier workload for this company because of all the electrification going on that needs a lot more grid equipment, despite that really strong recruitment that they've had to do, additional work that they're doing, their safety performance is actually really strong. So, that was an example where through that engagement, we got a better understanding and therefore now have a, more confidence, I guess, in that investment.
Yeah, awesome. And so how big is your investment universe? Like, because it must be the amount of, let's talk about the Climate Change Leaders Fund. Like, how many possible investments are there in global equities at the moment, and how do you then filter down to make a decision whether you invest in your holders, because it is quite a concentrated fund, is that right?
Yeah, it is. It's a fund of 15 to 25 names. The universe is it's actually pretty hard to pull together the universe, honestly. So we're global growth investors. So we're looking for not just any global equities company, not just any company that's kind of growing, but companies that are sort of structurally growing. So that sort of narrows the universe down. And then to kind of narrow it down further into that sort of climate opportunities, sort of thematic or area of interest, ultimately it's about 250 companies that we have uncovered, I guess, through our work. And really the key, just one thing that I really should mention here is that there are people that will, for a very large fee, sort of sell you a list of here are all the companies that sort of help make this happen. But we've found, honestly, that A, a lot of that information is kind of out of date. B, it's quite narrow. So often, like, for example, companies that help install transmission lines, which enable renewables to be put onto the grid. Like, so it clearly is helping enable decarbonization. Like, that sort of company isn't always actually captured. There are lists out there, but we've basically discovered and continue to believe that it's hard to actually put that to just rely on somebody else's list. Like, you've really got to do the work yourself.
Yeah.
So once we come up with that universe, then it's really about just applying the standard Munro Partners process, bottom up, and trying to find companies that really meet our objectives in terms of their growth trajectory and so forth.
So when you talk about bottom up, so you're looking at like what revenue growth, earnings per share growth.
Yep.
I guess the addressable market, etc.
Yeah.
There's some of the key things you look at.
Yeah, absolutely. So our investment process is effectively, once we sort of like narrowed it down to that universe, we really kind of bottom up look at 6 factors effectively for every company. We look at, you've got the two perfectly, the first two perfectly. So it's revenue growth. We want earnings to grow faster than revenue, which means that the company is kind of capturing some operating leverage effectively, like they're expanding margins, etc. The other one that we look at is like earnings durability, which is basically how volatile are the earnings through time. We prefer a sort of smoother ride. We look at control, which actually goes back to really my early influences from working at Axie. Like, control is all about, we're looking for companies that have founding shareholders that are still sort of managing the company, because we tend to find that those tend to be better run companies. So that sort of control,
agency theory alignment.
Exactly, like agency theory, agency risk, the whole 1930s Berlin means and all of that. That's how we run our business, and hopefully that's attractive to our investors too. That Munro, is sort of our CIO Nick is the largest effectively owner of Munro Partners. So in the same way that we want companies to act like that as well, we look at customer perception. What do the customers think of the product? And then the final thing is that sort of ESG analysis as well. So all of those things kind of help us to determine what we think is the appropriate earnings multiple for the stock. And then beyond that, we look at we model the P&L, effectively profit and loss statement, and we're looking for companies that can double their earnings over the next 5 years effectively.
Yeah, okay. And that have, great control over achieving that. And then less, probably, as you mentioned, less cyclical earnings.
Yeah.
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 So,
that's one of our kind of core sort of foundational beliefs. Like we think that, structural earnings growth and earnings growth generally is what drives stock prices. Structural earnings growth is worth more than cyclical earnings growth. And then, we find that often the market misprices the duration really of the sort of structural winners. And there's this sort of tendency for the market to think that, it's all kind of just going to mean revert. But we think that, for something like decarbonization that happens over many decades, it should present, multi-decade potentially tailwind for some of these companies.
Yep. No, thank you for sharing that. Appreciate that. So you did mention one company that you're invested into. Maybe let's talk about your top holding in that fund. You said GE Verona. Now, I know nothing. Venova. Sorry, my handwriting's not great. Can you maybe share? I don't know what they do. I've got no idea about that, and it's very rare that I'm not sure about a company. So I'd love to maybe share a little bit about it, how you came across that company and what they do and the investment thesis behind it.
Yeah, no worries. I mean, really, maybe just to start with the investment thesis, sort of shorter term. The longer term view for us is, we do think that we'll go from this, sort of higher emitting energy system to a lower carbon one over time. Short term, what really attracts us today is really the inflection in the US of electricity demand. So for 20 years, the demand for electricity in the US has effectively been flat. So any new demand sort of offset by industries leaving the US, like manufacturing, industrials and so forth, which are all very energy hungry. And then also like energy efficiency. So, better light globes, that sort of thing, like all of that does add up and will continue to sort of add up. But now with AI and, that sort of power required to run these bigger and bigger data centers with electrification. So, if you have an EV or two in your garage, you're doubling your consumption of electricity. As well as that sort of US trying to reindustrialize, like to bring these industries back from China back into the US. Those three things, AI, reindustrialization, and electrification, all of those are driving higher electricity demand. And really our view is that you need effectively like an all of the above solution to that. So you need more supply from gas, from renewables, from nuclear, from storage, do things more efficiently. And GE Vernova effectively provides equipment that helps sort of effectively try to sort of meet that supply challenge. So GE Vernova makes turbines for gas. They also do electrical grid equipment. They also do wind. So for us, the majority of the revenue comes from electrical grid equipment and wind. So for us, that sort of counts from our perspective in terms of fitting into this climate change leader strategy. But it's actually at the moment, to be honest, it's been the gas that's been a really big driver of their performance. Not that they are necessarily sort of adding lots of capacity to make more gas turbines, but they're effectively making a lot more money on the gas turbines that they're selling, because there is this sort of need to, as I said, add electrical supply to the grid in the US, but also gas has this important role at helping meet peak demand. So if you, GE Vernova effectively can make higher margins on selling their turbines, but then also on the servicing of the turbines as well. So a bit of a long answer, but that's effectively kind of what we're going for. There's an inflection in demand, and GE Vernova provides many of the solutions to help meet that demand inflection.
And imagine, to create competition for this company would be very hard. It's not something they could, they can just pop up overnight.
Yeah, exactly. Like these companies all suffered pretty much like near-death experiences a few years ago when, as I said, like it's been this kind of flat environment for many, many years. There are effectively 3 large gas turbine makers and similarly on the electrical grid stuff and similarly on the wind too, actually. But yeah, just to give you an example, using gas as the example, there are basically 3 companies that do that. GE Vernova, Siemens Energy, Mitsubishi Heavy. Siemens Energy, one of their competitors, which we've also invested in, basically had to be bailed out by the German government a few years ago because they were running at they were underutilizing their capacity and they weren't very profitable. So none of these companies have any incentive really to add new capacity. And I saw GE Vernova a couple of weeks ago in New York, and that's basically the message. Like, we'll sell you a gas turbine, but we're not going to be like putting together like some giant new factory to make more of them.
Yeah. Okay. So it's really like you said, it's the supply will be limited. It's just whether the price that they get for the items they're selling.
That's right. Exactly.
Yeah.
And then they also can, I think, now increasingly sort of, if you want a gas turbine, get in the queue, but then also we'll sell you the electrical grid equipment, which you probably want anyway.
Yeah,
as well. So there's that piece too, where they can really grow the market share.
Complementary revenue.
Yeah, correct.
Yeah, options. So you talked about sort of AI data center build outs.
Mm-hmm.
So that's been a hot topic in the press, and
yeah,
there's a lot of debt required. I think Amazon raised some capital recently, and some other these big, I should say Mag 7 or big US tech companies that are building out data centers. Which obviously creates opportunity, but is there maybe you can share some insight into what you're seeing in this space?
Yeah, I mean, at a high level, what we're still seeing is the capex for a lot of the sort of hyperscalers, your Amazon, Microsoft, Meta, etc. That capex continues to go up, and really, what we like about these sort of electrical equipment and sort of the companies helping to solve the sort of electricity part of the solution is, as I said, like it is more consolidated in some parts of the industry. It's sort of hard to replicate in the same way that's hard to replicate a GE Vernova, grid equipment or gas turbines. It's also hard to replicate, the people from Quanta that I talked about in the hard hats actually putting this stuff together and connecting it to the grid and all of that. So I think, if you were speaking to our CIO, Nick Griffin, he would still say that we do still see, the kind of CapEx from these hyperscalers continuing to go up. They're in an arms race, and they've been in these sort of technology arms races before, and they've always sort of been willing to spend a lot of money effectively on them. So we think that does continue. I mean, the nice thing really about some of these companies in the fund today is that it's not just as well. It's also like not just the AI that's driving that real reacceleration in electricity demand. It is also that sort of electrification of not just cars, but also buildings and things like that, which provides another tailwind for these companies, and that reindustrialization and that sort of, the kind of like policy priority of the Trump administration to, bring jobs and manufacturing and all of that back to the US.
Yeah.
So it's not just the AI that's driving these companies, but it is definitely part of it. And we still continue to be positive on the AI piece.
Yeah. And obviously Trump's in his second term. We're coming up to midterm elections at the moment.
Yeah.
If we do get, the next president that comes back and he's a big, bullish on globalization, does it change your investment thesis a little bit, or it's just something you reconsider at that point in time?
Yeah, I mean, especially it's probably a good opportunity just to talk briefly about. We are an active manager, and the turnover in this fund across all of our strategies is actually reasonably high. But one of the things that I just mentioned in this case is, this is a fund that's all about companies that are helping enable decarbonization and climate change. And so the whole policy piece has been really like a wild ride. When I joined in 2021, it was, Joe Biden, and then he brought in the Inflation Reduction Act, which is a huge stimulus for all sorts of green spending, green capex, et cetera, like really supported this whole industry. Donald Trump kind of comes back, climate change is a scam, and you sort of think like the whole area is dead. But we've managed to sort of navigate that reasonably well, to Nick and James's credit. So I think that we continue to be kind of attentive to, I guess, what's happening on the sort of politics and policy side. On the kind of globalization piece, I think it has been really a consistent, like, bipartisan piece, honestly, probably since late in Obama's administration, that sort of US-China thing. So I'm not an expert in the geopolitics of all of this, but I don't really personally think that that's likely to radically change anytime soon. And then if the politics in the US does change and it goes back to the Democrats, like, from a policy perspective for climate change sort of policy support, that can only be a positive.
Yeah, of course. And so it's we're not sure when we'll release this episode, but it is the 17th of March, 2026 today. And there's oil price is above $100 US dollars a barrel. And there's concern around, the conflict in Iran and whether 20% of oil can actually be distributed across the globe.
Yeah.
That must be positive for your fund in terms of high oil prices. It means that, the substitute greener energy becomes more viable.
So yes, conceptually, yes. And I would say, I'll give just one example, a company called CATL. I'm not sure if you're familiar with that, but this company is basically the largest producer of batteries globally. So they make batteries for electric vehicles. They also make batteries for the electrical grid. And as I said, on the grid, it's really that challenge of, like, meeting that kind of peak demand, which is hard to decarbonize, honestly. So CATL and their grid batteries really are a key part of that solution. So you'd think that, all else equal, higher oil price should mean more of a push by China to support a company like CATL, because every combustion engine vehicle that's substituted for an EV means less dependence on oil, and the majority of Iran's exports, my understanding is, do go to China. So you're right. Like, I think broadly speaking, yes, it's true that it should be positive for this fund. I suppose that there are also obviously all sorts of macro factors that we have to think about. So if higher oil price means higher inflation, then we have a few utilities in this fund, which we think still meet our growth trajectory. But utilities tend to do well when there's lower interest rates, and so if you get sort of a higher interest rate environment, the utilities probably won't do kind of as well relatively. So we are trying to not. I think if James was here, he would say we're trying not to effectively overreact to all of this. So I don't think we've made really, like, super radical changes, but you're right. Any company that helps reduce reliance on oil in this environment, particularly for China, is probably, should continue to do well.
Yeah. And in terms of the fund, you said 15-25 holdings, and how long's we're talking about the Munro Climate Change Leaders Fund. How long's the fund been running for, and can you share some insight into performance? I saw that up to February 2026, your 1 year numbers were 35%, and since inception, 19.5%.
Yep.
So how long's the fund been running for? And
so the fund itself has been running since late 2021, but Nick and James have been investing in this area of interest, as we call it, or theme, really, I think, since the late 2000s, so for a lot longer. We've been sort of very happy with the performance. It's an area that a lot of things have changed that we wouldn't have necessarily expected. So through that period, we've had a big increase in interest rates, which sort of obviously hurts higher utilities and also sort of high valuation stocks. We've had like a full 180 in the policy support for climate change in the US. The rest of the world has actually been much more, predictable and hasn't changed too much in terms of the policy support. And then I think the other thing that obviously we couldn't have predicted at the time was just this kind of this electricity demand inflection, and just the simple fact that apart from gas, all of this, most of the solutions to meet this are low carbon solutions. So, it's been one where definitely the active management has helped us a lot. Active management, our stop loss process, which I can go into, all that sort of thing, has really helped us a lot at achieving that. Because if it was just like you've seen lots of these sort of similar kinds of funds that are more passive, I think just sort of struggle just because of the quality of some of the kind of solar names, electrical vehicle companies, that sort of thing. You've had to be very, I guess, nimble and that sort of look at things bottom up to find the actual winners that can be profitable in this area.
Yeah, and also the long-term value, because there must be a lot of volatility in these stocks. But if they're able to continually grow their revenue and earnings per share, etc., and there's demand for their product over the long term, then the share price will follow the earnings.
Exactly. Yeah, that's right. That's exactly like our philosophy. We're looking at companies that can grow their earnings. That's what we're focused on. We're not sort of focused on the shiny new technology sort of necessarily out there. Some of these companies have been around for a really long time. Like, GE Vernova was an example that we talked about earlier. Quanta, the people in the hard hats putting up transmission lines, another example. They're just like good, well-run companies that are profitable that are now benefiting from the structural tailwind. And so it's that sort of company, I think, that's been more successful for us rather than, chasing the latest, transformative solution, that company that doesn't have any revenue, let alone profit. Yeah.
Yeah. And Munro Partners, can you share a bit of information about Munro Partners as a
firm?
Yeah, as a firm.
Yeah. So we are based in Melbourne. We have an investment team which is all based in Melbourne, and we're global growth equities and structural growth equities. So we have about $7.5 or close to $8 billion funds under management. And really, all we're looking for across all of our areas is structural changes. So I think we've talked about it a few times, but the kind of classic example is, cash to card and the winners from that transition. Yeah. In the same way, that's how we think about climate change, as a transition from, a high emitting energy system to a lower emitting energy system, and who are the winners from that, and try to find those structural winners. That's sort of how we work. We have, we effectively have, 4 strategies. We have a global growth equities strategy, which is an absolute return, which has some, can go to all 100% cash, has some currency hedging and some hedging more broadly. We have a long only strategy, Munro Concentrated Global Growth Fund, which invests across really the same themes as the first absolute return fund, many different themes or areas, and tries to find the best companies across all of those. As I said, we have this sort of climate change one, which is just focused on that one area where we think, and there's a lot of overlap amongst with the other fund as well, but that climate change thematic. And then we have a small and mid-cap fund, which is effectively same team, same process, and working on companies, in the sort of small and mid-cap range, where we think, there are many undiscovered companies that are, benefiting from the same tailwinds as our sort of all-cap fund as well.
Yeah, and is there a minimum market cap that you would consider for the small mid-cap fund?
Yeah, I mean, across all of them, we can get pretty small, but I mean, in reality, we tend to be probably, this is like small and mid cap by US standards. So they tend to be like, 5 billion kinds of, 5 billion market cap kinds of companies. And it's really, we look to, companies that can be like up to, 25, 30 billion as well.
Yeah, awesome. And from my understanding, the Munro Partners is the key people in the business are partners in the firm. Yeah. Is that right?
Yeah, that's right. That's right. I think we sort of touched on this a little bit earlier when we were talking about companies and how we think about companies, and we want companies with a controlling shareholder. That's how we run this business ourselves. So in the beginning, it was Nick Griffin, our CIO, Ronald Calvert, who's our CEO, and another gentleman, John Spenceley, who sort of founded it. And they were the kind of equity partners at the very beginning. They had some others in the team as well. And really, like throughout this entire period, it's been basically a process of trying to align the rest of the team with and make them partners effectively. So I've been fortunate enough to have been made a partner, and that's effectively, all of that is effectively like Nick and Ronnie essentially kind of diluting themselves and sort of sharing that opportunity to, I guess, participate in the profits of the business, which we think kind of really ensures that alignment amongst the team. I'm not upset or jealous if James or whoever takes a different view on a stock to me and they say, well, we should sell that stock. I'm not really upset about it because I know that they're 100% aligned with what I'm doing. And in the same way, when I'm proposing something, they know that I'm aligned in terms of what I'm trying to achieve as well. And all of that is ultimately as well aligned to what our investors, what our investors' goals are as well. So, it's a really nice thing about this organization that we are sort of small. We are, I guess, boutique, and we are sort of founder led.
Yeah. And across your strategies, I believe you have listed strategies through active ETFs on the ASX and then also through a unitized managed fund that if people are on a platform, they can access as well. Yeah,
that's right. So of the 4 strategies I mentioned, 3 of them being the absolute return, the concentrated global growth, which invests across all of the themes, and then the climate change leaders fund, they're all available via the fund and the ETF. The SMID is only available via the fund. And there are a few sort of reasons for that. One being around kind of disclosure of the names in the portfolio, which I think we're a little bit more sort of sensitive about on that fund. But if you go on our website munropartners.com, you can find kind of all of that information and go from there.
Yeah, well, thank you very much for coming on, Mike. It's been a pleasure and sharing your story of how you got to where you are today and working at Munro Partners, a very reputable and well-known fund manager here in Melbourne and nationally and obviously internationally. Now you've got some international investors as well, so congratulations, and we look forward to seeing the growth of the fund continue.
Yeah, thanks very much for the opportunity. It's been really a fun conversation, and hopefully we can do it again sometime.
Most definitely. Thank you. Thanks for listening this week. Stay tuned for our next episode and keep up to date with us by following the Finance Friends podcast on Instagram and TikTok. Plus, connect with us and our guests over on our LinkedIn page, all linked in the show notes.
Disclaimer: this podcast exists for informational and entertainment purposes only. The personal opinions of the speaker and guests do not represent the view of any other party. If this recording contains reference to financial products, that reference does not constitute advice nor recommendations and may not be relied upon.